topic here. We have IFRS 17, and we have Brendan Thorpe, who is going to be taking us through. Over to you, Brendan. Thanks.
Thank you. Thank you firstly for coming back after lunch and for enduring an IFRS 17 presentation. I know everyone's probably got a little bit of, we've been a little bit scarred maybe by IFRS 17, but I think it is a good idea. The theme of this year's conference is going beyond the numbers, and that's exactly what I wanted to do with this paper and this presentation. Is we've been through the trenches, we've done the hard yards, we've now got the results, and what do those results actually mean? And I think it started out as, what can we tell from these results? And it kind of morphed in a little bit into, well, there's actually a little bit of difficulty sometimes in comparing these results, and there's some nuance that needs to be taken into account. So yeah, that's the crux of what I'll be discussing today. But yeah, thank you. I look forward to any questions at the end. So where I wanted to start, because I know there's obviously some very strong views on IFRS 17, and I'm going to try and tread the line here of being not too positive, not too negative, because some people might think I have Stockholm syndrome if I'm too positive about IFRS 17. But where the world found itself in the 1800s, to use an analogy, was there was no need for very accurate timekeeping. Each town or each city would set its clock tower to 12 at the midday sun, and there would obviously be some variability there, and it didn't really matter if one town's time was off by a few minutes from another town's time, because travel was measured in days, not minutes or hours. And with the rise of trains, obviously travel became a lot more accessible and a lot quicker. And that created a problem, because if you had a train scheduled at 13:09, is that 13:09 this city's time, that city's time, another city's time? And that lack of alignment really created a big problem. And there was a solution to this that was proposed, and as all solutions go, it seems very good in theory that there would be 24 equidistant time zones. And then, like I say, that's the best laid plan, right? That's exactly what it's going to be. That makes the most sense. In reality, though, you're on the right-hand side there, which is every country kind of adopts things in a slightly different way just to make things suit them, whether it's politically or economically. And so you've got a proposed theoretical solution which is perfect, and you've got an actual implementation which is not perfect, but better than what it was before, when everyone had their own view of time. So the question then is, how does this relate to insurance accounting? Well, similarly, under IFRS 4, we found ourselves in a position where globally there was no alignment. Basically, IFRS 4 said, continue to do what you do, and everyone did what they wanted to do. There was some attempts at standardization, and actuaries were the driving force behind that. People remember SAP 104. But even within that framework, there was a huge discrepancy. And so IFRS 17 was worked on for many, many years, as everyone knows, and it was proposed. And it was proposed to create that standardization. But just like these equidistant time zones, it was never going to result, I think, it's too lofty to expect it to have resulted in a perfectly theoretically comparable world. And so there's a lot of interpretation and judgment that's been applied. And so we end up with an imperfect system, but I think it's good to recognize that that imperfect system is still better than the system of where it was before. And with that in mind, I suppose the question then is, to what extent have the aims of IFRS 17 been realized? So IFRS 17 wanted a consistent set of principles for the recognition, measurement, presentation, and disclosure of insurance contracts to enhance comparability of financial statements. So as I said, we've got areas of judgment, and I think that the important thing here is that things are a lot more comparable than they were. But what I want to bring through this presentation with some specific examples is the fact that context is really key. So, it's not enough to just take one table from one insurer, another table from another insurer, and make basic comparisons on them, because there's nuance in terms of the judgment and what's allowable underneath that, which I think is important to understand. And to that end, I'm going to talk through 3 of these notes. So we've worked through in detail on 3 of the notes, starting with new business profitability, Now, obviously, so we're starting at the point of when we write a contract, how much margin? And there's a requirement in IFRS 17 that you disclose new business profitability. And what you have to disclose there is split between onerous and profitable, and you have to disclose PV of insurance, PV of acquisition costs, PV of any other outgo, PV of inflows, risk adjustment, and CSM. Sorry, just I'm just going through the detail just for those who don't necessarily work with these disclosures that often. That's the body of information available in that note. But that basically tells you, of the business you've written, how much margin have you generated on that business in this year. The next important note, which is a very important note from an analyst point of view, is the recognition of CSM and profit and loss. So that's, we've developed this margin, we've generated it by selling this business. How is that margin then going to emerge in profit and loss? How do we expect it to emerge in profit and loss? And there's quite a lot of nuance there that I think is important to understand. And then we've now generated margin, we've released margin, we have an expectation of how margin is going to release in the future. What happens if that doesn't turn out? And that's where we start looking at sensitivities and what information we can glean from that. So I think before I kick off on the detail, I'll just make one more point, which is to say, I think what's also very daunting about IFRS 17 is the volume of information that's being presented in financial statements. Everyone presents it in a slightly different way, so it takes quite a lot of time to kind of trawl through the financial statements of insurers. And that's why I'm hoping that this kind of starts a discussion, because there's a lot of discrepancy in terms of how people do things, and it wouldn't take very much, I don't think, to get a lot more alignment, which would make things a lot more comparable in a much easier way. But obviously what complicates things is IFRS 17 didn't create actuarial complexity in valuation. It just enhanced it by bringing it into the face of the income statement and the balance sheet. And so I think that's the real challenge, is that people think IFRS 17 is extremely complicated. I'm not disputing it's not complicated, but a lot of that comes from the complication used to be hidden, and now the complication's been elevated into the financial statements. So hopefully we can, as we talk through these things, we can see what lessons can we learn, what insights can we gain. And I'll discuss some recommendations in terms of, can we as actuaries drive some discussion to potentially enhance this comparability between insurers. The analysis that I've done is based on, I've just given the timelines of the conference. It's all based on 2024 year ends. So for June insurers, that's June 24, and December insurers, that's December 24. So there wasn't, just given the deadlines, there wasn't time to update to the latest 25 results for the junior insurers. Okay, so if we look at new business profitability, as I said, I mean, there's the requirement to show PV inflows, PV outflow split with acquisition costs being shown separately, risk adjustment, and CSM. So the first thing that it allows us to do is just, before we get into any detail at a high level, one more thing before we get into the detail. This analysis is based on 5 of the large listed life insurers in South Africa. And where, for interest's sake, so those are big insurance groups, so they'll have a diversity of products. For interest's sake, in certain elements, I've added a bank insurer, which is more monoline, which I think just kind of heightens, shows some of the differences that one can see from the disclosures of a monoline insurer. So, at a high level, before we get into the detail, we can do some simple analysis, which is just looking at 23-24, what's happened for the industry as a whole. So present value of inflow has reduced, and the total CSM has reduced across there. And there's perhaps some bigger swings between insurers than you might have first thought. And the margin in the industry, the total margin has reduced. What we can then do is, so in this graph, what I wanted to do is look at a case of, well, let's specify everything as a percentage of present value of PV inflow. So what this graph is basically telling us is, for every rand of premium that the company is going to earn on this policy, what is it going to use that rand of premium for? Is it going to be used to pay claims? Is it expected to be a profit driver? Is it being used to pay acquisition costs? And you can already see very big differences arising between insurers. Now, this is at a total level. And yeah, we've anonymized the insurers here, but you can already see at a total level that there is big discrepancies. And you can see insurer F there is the bank insurer, which just looks very, very different in terms of its structure. So can we draw any conclusions from this, just comparing it? Now, it becomes very difficult because it's very difficult to be definitive about what exactly is driving the differences. And the reason for that is that GMM business is very heterogeneous. So you can have everything from a fully underwritten whole of life escalating policy to a life annuity to a funeral policy to a 5-year guaranteed endowment if there's risk attaching to it. And so it's very difficult then, just given the fundamental differences within those product constructs, to draw any conclusions, right? Because there's different maximum commission rules and all those sorts of things. Another thing that would complicate this is, here comes the judgment. You know, an insurer could choose to disclose a particular line of business in a simplified way through the PAA, whereas another insurer could choose to disclose that business as GMM. And so you've got two distinct lines of business being disclosed in two different places, which makes results less comparable. If we look at then what we can tell from this, so we see risk adjustment is relatively stable across the insurers, except for the bank insurer is a lot bigger, and then obviously one of the others. Now, the interesting thing there is the one element of comparability which the ISB wanted to introduce is through the risk adjustment confidence level. These insurers will all have different risk adjustment confidence levels, and yet they all end up with a similar level of risk adjustment as a percentage of PV inflows. And I think that calls into question, you know, how useful it is really, because defining a risk adjustment confidence level is, you don't know how that's been calibrated for each insurer. So yes, you know the level of confidence, but you don't know what risks, how it's been calibrated, how it's been implemented, how it's been modeled at a policy level for allocation of business from profitable to onerous. And then I think another important thing to note here is just, you know, the nature of these large insurers in South Africa is that there's exposure to business not only in South Africa, but they have a footprint across multiple jurisdictions. Now, where there is evidence of one insurer splitting that out, you can already see how big that impact is. So this is for the South African business. The acquisition cash flows are 13% of the, or 13.7% of the PV inflow. For the UK business, it's 25.4%. So you can imagine if those results were presented together, you would see a much higher average. And that would be skewed a little bit because of that jurisdictional impact and the relative size of each jurisdiction in the total GMM disclosure. So now if you look at, well, I mean, so then I feel like I want to pose some problems and then hopefully come up with some solutions. So, you know, this last slide is, well, it's not that comparable. We can't be that definitive. We can make some educated guesses around what's happening. So then your next logical conclusion might be, well, let's look at what's happening year on year, because surely that will be a lot more useful. So don't look at what's happening between insurers, but look at what's happening within an insurer. Now, even that becomes very tricky. And the reason for that is, whereas in EV, there's quite a detailed new business or VNB margin analysis for most insurers. For IFRS 17 at the moment, a lot of the numbers are kind of just presented as a table of numbers. And there's very little qualitative information provided surrounding that and explaining any movements year on year. And I mean, that's across all of the disclosure notes, really. It's just, you know, wall-to-wall numbers for about 20, 30 pages of the financials. So if you want to try and look at a year-on-year analysis, so you can see in the bottom there, in the bottom graph, I've got new business CSM less loss component as a percentage of PV inflow. So why are we seeing a decrease year-on-year for insurer A? Why are we seeing an increase year-on-year for insurer B? There's a lot of things that are going on, right? We've got yield curve changes happening, we've got other demographic basis changes that are happening, and that could have an impact in the subsequent year. We've got differences in the underlying mix of business. As we've discussed, mix of business is very important. And so with little to no information being provided, again, it's kind of an educated guess that has to be provided. And I mean, we can go into, there are some educated guesses, I suppose, of why we've seen what we've seen year on year, just given the information of a client, of an insurer. But I think in order to enhance this and to make it more usable for a user of financial statements, I think some degree of discussion within that to give some qualitative information, I think would be very useful. Okay, so when we look at a total level, we can't be too definitive. When we look at insurer in a particular insurer year on year, we can't be too definitive. So I'm still not being too helpful, I suppose. But what we can then do is we can go and look at a profitable level and at an onerous level and do that split and see what information can we get from that. And what does that tell us about what insurers are doing? So this is the graph of profitable business. And you can see some interesting things coming through here now, where there's, for insurer B and C, structurally, there's quite a lot lower acquisition costs. Again, we can speculate the reasons to that. I mean, that could talk to the nature of the business, just if that's annuity type business with a lower commission, regulated commission, that could be explaining that. It could be the way that expenses are being allocated as well. And then the interesting thing comes when you start looking at onerous business, because it's a lot less volume, so you see a little bit more volatility, and I think it's quite interesting when we look at the analysis of that. So the way that I've looked at that is, rather than looking at this split, it's looking at this split. So what we're looking at in this graph is the onerous business as a percentage of the total. So we're looking at the PV of premiums on onerous business as a percentage of the PV of premiums for all business. And we do the same for acquisition costs, claims and other expenses, and the risk adjustment. And this is where we start to see some interesting patterns emerging, and we can start to draw some conclusions on what different insurers are, or the approaches of different insurers on certain items. So the first interesting observation I think here is just when you look at the PV of premium relative to the PV of claims and other expenses, you can actually see that for most insurers, except for insurer A, but it's marginal, for most insurers, onerous business represents a higher percentage of PV premium than it represents of PV claims and other expenses. So what this tells me is that insurers in South Africa are not pricing business to be onerous. It's not on a risk premium basis that this business is onerous. The premiums represent a larger proportion than the claims and expenses. So it's the other items, it's the acquisition costs and the risk adjustment that are driving that business to be onerous, which I suppose is a good thing. Now if we look, so we saw earlier insurer B and C had the lowest proportion of acquisition costs on their profitable business, but they have on the flip side the highest proportion of acquisition costs on their onerous business. And for insurer C, 22.5% of the premium that was written in the year is driving 80% of the risk adjustment in the period. So again, that speaks to the heterogeneity in the products, and in terms of the higher risk adjustment products are the ones that are ending up being onerous, and that's probably a nature of business thing. But the acquisition costs are the real interesting item, I think, because what it indicates is different approaches having been taken in terms of how acquisition costs are allocated to at a per policy level. So for insurers where there's a closer alignment between the proportion of onerous business, PV premium, and acquisition cost, that indicates that there's probably some sort of premium driver or profit driver that's being used to allocate acquisition costs, and where you see the big misalignment between premium and acquisition cost, that probably indicates a more kind of fixed acquisition cost loading. Now the interesting thing on this is that I think we can all agree this is quite a material assumption. The assumption of how we allocate risk adjustment to a policy level, how we allocate expenses or directly attributable acquisition expenses to a policy level. And yet there's very little disclosed around this in any of the disclosures. So, I think we need to ask ourselves, is this an area where there needs to be additional disclosure? Because a user of a financial statement here could say, well, this insurer is doing a better job than that insurer because they've got less onerous business. But they're missing the context of there's a fundamentally different approach. And it's not wrong to have a fundamentally different approach. And it also doesn't mean that you're pricing business necessarily to be loss-making. So, I mean, summarizing this section, we've looked at the new business disclosure, and I mean, I think for me, what would really help is that if we could get a more granular split. So, I mean, I know people might squirm at the idea of additional disclosure when it comes to IFRS 17 because there's already so much, but we've gotten 95% of the way there, and I think the question is, well, for a little bit more, would we really enhance the understanding, even if it's just qualitative, not necessarily quantitative? But if we could get a better idea of the granular split of contracts initially recognized, so the nature of the benefit, the distribution channel, the market in which the contracts are sold, even if that's described qualitatively, it could go a long way to helping a user of the financial statement really understand what's driving those differences. I do think that more detailed information on the allocation, I've got there of directly attributable expenses, but I do think the risk adjustment as well, those are fundamental decisions that drive new business profit and new business losses, and at the moment they, to all intents and purposes, aren't really being disclosed or discussed, and I think that's an area where we could benefit from enhanced disclosure. And then, mirroring what was done in EV, if there's a little bit more, focus on, well, what is our CSM margin? How much CSM is being generated per on the PV of inflows? What is the reason for that margin change year on year? Is it, just are you a taker of it because of the economic environment? Is it because of decisions that have been taken last year that are impacting, basis changes that are impacting this year? Is it a mix? Is it a mix thing, which speaks to the first point? If you disclose a little bit more around the mix, I think that can help as well. But I think, so that's, in my view, what we as industry can maybe push for to enhance the usability of this for users of financial statements. Okay, so we've dealt with the first part. Like I say, that's the generation of margin. And that's a very important thing, having spoken to a lot of analysts, that's a very, very important item that they look at each year, because they're looking at how is your margin being replenished each year, and that obviously comes through new business. But then obviously the next important item is what's actually impacting your income statement, which is the recognition of CSM. So this is just a simple illustration of profit under IFRS 17. So if we focus on the insurance service result in isolation, I'm assuming here that actual equals expected. We all understand that there's a lot of cancellation of these items, so this looks quite complicated in terms of what's driving profit. When you simplify all the offsetting items, it simplifies quite a lot to your insurance service result is really being driven by recognition of your margins, so your CSM and your risk adjustment, and then the impact of your onerous contracts, which is what we've discussed earlier. So recognition of CSM, it's one of the key items that analysts are looking for, and it's one of the key drivers of their analysis. When they do projections of the business and how they expect things to progress, it's the first thing that they go and look for. So this is just looking at, in the past in terms of what we've seen for each insurer, split GMM VFA, just in terms of that CSM balance moving year on year. So, what you can see is there's quite a lot of variability within the industry, and there should be, right? The CSM exists to absorb variances so that there isn't income statement volatility. So it's not unexpected necessarily that there is this volatility. But the requirement of the standard is we now need to look at, given the CSM balance at the end of the year, how do we expect that CSM to emerge over time? So that's all on an expected basis. So it sounds really simple. Paragraph 109 in itself is very simple. It just says the insurer needs to show how the CSM is going to be recognized in profit and loss. So you would think if it's simple, everyone would implement it in the same way, but that isn't the case. So I've got there the different interpretations across the industry. So we've got differences in a number of items. Firstly, in terms of the disclosure. So I know some insurers have now added additional years of disclosure in their latest set of financials, but these are the 24 ones. But in terms of the time periods that are disclosed, there is quite a lot of variability. And then the important one is whether the runoff of the CSM that you're showing allows for the accretion of interest or whether it doesn't allow for the accretion of interest. Now, if you're in a low interest rate environment, that's not that important, but in South Africa, it's a very material driver. And it's interesting, like I say, you've got a very simple requirement, but you've got something really, really fundamental that differs between a lot of insurers. So why is that? Well, there's two different approaches, and neither of them are wrong in terms of what's required. So what's underlying it, though, is approach one is saying, I've got a CSM balance. How do I expect the coverage units to run that CSM balance off going forward? Approach two is saying, I've got a CSM balance. That CSM balance without variances is naturally going to be accreted with interest, and then there's going to be a release, and there's going to be accreted with interest, and then there's going to be a release over time. And so, that would be the amount that actually would be reflected in profit and loss in the future. So both of them meet the requirements of the standard, and that's why there are different approaches that have been allowed by the audit firms. But it's very, very difficult for a user of financial statements to, if you don't have that insight and you don't have that context, you're comparing one with accretion to one without accretion, you're going to end up with a very, very different idea of where things stand between insurers. So what I've done is, looking at that, I've standardized insurers, so given the treatment. So we've looked at the CSM runoff, so some with accretion, some without. And in instances where we don't have the accretion rate, we've had to make assumptions around that. And we've also used linear interpolation where the values weren't available. And we've just looked at the first 10 years. So now on a consistent basis, this is all of the 5 insurers without interest accretion. So this is on approach 1. And you can already see some quite big discrepancies between the insurers in terms of their runoff profile. So this speaks to the coverage unit that's been selected by each insurer. But quite wide variability there in terms of the levels of the runoff after 10 years. And we can already see insurer A on this basis looks the most conservative runoff. The insurer D looks the most aggressive runoff. Then if we allow for interest accretion, it doesn't necessarily change the message, but it does show, the situation where actually quite a lot of insurers have a CSM balance and over 10 years expect that CSM balance to either grow or remain relatively stable, and that's because they've got parity between the accretion rate and the release rate. But again, it doesn't necessarily change the messaging that there's one outlier in terms of being looking quite conservative, and there's one outlier in terms of looking quite aggressive. But this in itself is another problem. So if you just stopped here, I think you have a problem, because there's so much difference between insurers, as we've spoken about before, and the heterogeneity of the business. There's so much difference. So if I'm an insurer and I only sell funeral business with very high lapse rates, and I'm another insurer and I sell whole of life business with very low lapse rates, well, I would naturally expect the CSM of the first insurer to run off quicker than the CSM of the second insurer. So a straight comparison of the CSM runoff is not necessarily, it tells you a piece of information, but it's not necessarily the most useful piece of information. And so what I wanted to do here was, how can we get some insight into a little bit more detail around how is your CSM running off, and is that CSM runoff reasonable? And the question is, well, what's reasonable then? Okay, sorry, before I get to that, I just thought, well, this is quite an interesting slide, I think, just to kind of show that South Africa is not out of step with the rest of the world. So I've got a KPMG survey on the left-hand side there, which shows, I think it's 57 global insurers. And you can see that on the South African, this is how much CSM has been recognized within the first 10 years without accretion. And you can see that the South African insurers are pretty much in that same range. So we're not wildly out of step with the rest of the world, which is a good thing. But yes, the absolute runoff of the CSM balance is only one consideration. And when you're assessing the release of the CSM, you need to assess these more nuanced items. So what are the types of products? What are the development over time? What are the sales channels? Because that's going to affect the lapse rates. What the underwriting practices, that's going to affect the runoff of the policies as well. How do those policies escalate? Is there an inbuilt escalation? Is it a level premium policy? And so the piece of information then that we can utilize to try and get a sense of the reasonability of the runoff are the maturity analyses. So IFRS 17 requires, again, in terms of the disclosure, paragraph 132B, that an insurer basically produces a maturity analysis of the insurance contract liability. Unfortunately, this is, we've spoken about how things are incomparable. This is the most incomparable of everything. But I don't think that detracts from it. So we've had to make some assumptions here. So some insurers will show the maturity analysis of insurance contract assets and insurance contract liabilities. Some will only show for insurance contract liabilities. Some show basically the maturity analysis of the BEL. Some show the maturity analysis of the BEL risk adjustment and CSM. So we've had to, use a little bit of logic and work through it, but I don't think that necessarily takes away from the message. So what we wanted to do was look at the runoff of the liability profile, look at the runoff of the CSM, and that's a very important comparison item, because if your CSM is running off very quickly, but your liability is running off very quickly, that seems like a reasonable approach. If your CSM is running off very quickly and your liability is running off comparatively much slower, in 5-10 years' time, you're going to be in a situation where there's not much margin left, but you've still got a big liability exposure. And so we've done that for each of the insurers. And so where you see an asset and liability, that's where that was provided, that information. And where you see just the liability, that's where that information was provided. So it changes the story a little bit. Now if we look at insurer A, you've got the CSM on its conservative trajectory, but you've also got the insurance contract asset on actually a steeper trajectory, and then you've got the insurance contract liability running off quite quickly. But at an overall level, it doesn't seem unreasonable, but it's not necessarily as conservative as it maybe looked when you just did a straight comparison between the CSM runoffs of the insurers. Insurer B, that liability runoff looks, or the CSM runoff looks quite conservative relative to the liability runoff. Insurer C, we're sitting at a position where the liability runoff is bookends the CSM runoff, and actually there's a little bit more weighting towards the insurance contract liability there, so it might be slightly quicker than that runoff. Insurer D, we still see the same. We get the same message where the CSM is running off quicker than the insurance contract asset and liability, and then Insurer E's got a very, very close runoff trajectory between the two, which appears quite reasonable and quite conservative. Now, obviously, all of this, to caveat it, is there's been some assumptions in terms of how we do that liability runoff, but also it takes into account best estimate experience and the assumption that that's going to continue. So, to the extent that there are positive variances going forward, that would adjust where these lines end up. But I still think it's useful to have that context in terms of comparing CSM runoff as not just a straight comparison, and there's some nuance to it. The final point I wanted to make on CSM is, I've called this not CSM is created equal, and there's a reason for that, because on GMM business, CSM, as we know, is measured at initial recognition rates or locked-in rates, colloquially. And so you end up in a situation where the rate on which CSM has been determined for different groups can be very, very different from the current rate. And when you want to try and unlock that CSM for any variance, you can have a very big discrepancy between the actual economic value of the basis change or the variance and the impact of that measured on initial recognition rates. And if you don't use OCI, that impact goes straight through to your income statement. So where this is a thing, I think especially for the next few years, transition numbers are going to dominate for a long time, because it's many, many years worth of information all stored in a single point. And for insurers who've done fair value transition, they're going to have a very big group at a very particular rate of interest. Whereas if you've done for retrospective, you're going to have many more groups, all at very different rates of interest. And it's important, and we'll talk about it now in the sensitivities, that information is very important because it affects the rate at which you unlock CSM, but it then has a consequential income statement impact as well, which I think is potentially quite difficult to explain, or it requires some nuance in terms of explaining and understanding. And I think just to drive this point home, I saw this graph for the US, and I wanted to do it for South Africa, just to show how variable, I think we all know nothing turns out as expected, but just to show how variable that actually can be. So I've plotted there the repo rate, and overlaid with that, I've plotted the Prudential Authority 3-year rates in 6-monthly intervals. And so you can see the gray is where we would have expected to move along, and that's what would be locked in, and that's what we would move along. That's the rate we would move along, and the red is actually what transpired. So these are very important considerations, I think everywhere, but especially in South Africa, because there is that discrepancy. I mean, if you look just before COVID, if you're locking in that rate there on a very upward trajectory, and then a few months later, you're locking in a substantially lower rate, a few percentage points different, you can have very, very big impacts, even within a short space of time for business that's just recently been sold. And I think that's another important consideration. When you look at CSM, you can look at how you expect it to emerge, but the reality is it's never going to emerge exactly in that way because you are going to have variances, and it's important to understand how those variances impact or are impacted by these interest rate differentials. So again, on here, my recommendations, my viewpoint is, I think we could look at maybe consistent disclosure, or maybe you disclose on both bases, just to ensure that there's no risk of that incorrect comparison between insurers. And I think this might be a long shot to request of insurers, but some degree of commentary around the coverage unit chose and how it, how the CSM runs off relative to the liability or the asset, and why the insurer feels that that's a reasonable runoff, I think would be useful. Okay, and then finally, going to look at the impact of sensitivities. So sensitivities is another area where it's potentially very meaningful and useful information, but there's a lot less standardization between insurers. So yeah, paragraph 128A requires an insurer to show the profit or loss and equity impact of basis changes, of these sensitivities at the end of the reporting period. So again, you would kind of think it's easy to interpret, or that everyone would have the same interpretation, but we don't necessarily have that, and I'll get into that just now. But what I wanted to talk about is, when we look at sensitivities, I think it's important to look at it in this way. So we've got two things going on because we're in GMM business. We've got measurements on initial recognition rates, and we've got measurements on current rates. So I've split out the impacts there into those 4 factors, A, B, C, and D. So A is the change in fulfillment cash flows on your profitable business, so that would be impacted by a release of CSM. B is change in fulfillment cash flows on onerous business, which would go straight through to the income statement. And you've got those same 2 factors measured on initial recognition rates and on current rates. Now, if you don't disaggregate through OCI, what happens is A represents your CSM impact, as I think we all agree. Your profit or loss and equity impact then becomes B, plus then the differential between C and A and D and B. And that represents what I was talking about just now in terms of measurement on initial recognition rates versus current rates, that IFIE, that insurance finance income and expense impact, has to go through the income statement. And that's what that C minus A plus D minus B factor represents. And so if you add those two together, your total impact solves basically to C plus D, which is exactly what you would expect. Economically, the impact is C plus D. If you disaggregate through OCI, you have a CSM impact of A, as the same for the no disaggregation. Your profit and loss impact is just B, because that IFIE component is all taken to OCI. And you end up with exactly the same total impact when you look at the total impact. So some of the issues with direct comparisons of sensitivity. So I spoke about the fact that there are discrepancies between insurers. So some insurers will only provide sensitivities in a single direction. The problem with that is it's not necessarily true that there's going to be a symmetric impact. So that could be true just in terms of the basic Bell impact. They're not necessarily symmetric for an up and a down stress. But especially for IFRS 17, where you're starting to look at profit and loss impacts, because you've got this underlying level of detail of IFRS 17 groups, as I've tried to explain there with that visual, you could have groups, 3 groups, all with a positive CSM. Positive impacts, nothing will touch the income statement because it all goes through CSM. Negative impacts, for 2 of the groups, that impact would impact profit and loss because the CSM isn't sufficient to absorb that impact. And so to only show stresses in one direction, I think, isn't that useful to a user of financial statements, because perhaps different to the EV, you can't just put an equals minus to get the opposite direction. For GMM business, we have that impact of current versus initial recognition rates, and where an insurer hasn't elected to use OCI, you don't see the detail of how much of your equity impact's being driven by, or how much of your profit and loss impact's being driven by that item versus how much is being driven by a genuine increase on losses on onerous business. And then there are a myriad other differences between the insurers. So people use different levels of stresses. Some combine mortality and morbidity stresses. Some show mortality on annuity and assurance business. Some don't. Insurers C and D are interesting in that all other insurers apply sensitivities at the end of the financial period, basically on the closing balance, whereas insurers C and D apply it and then allow for the consequential impact of the CSM balance differing and then having a different CSM release. So that offsets the stress to some extent. So again, there's some discrepancy there. And yeah, there's some discrepancies just in the basic stress percentages that are applied as well, which also hamper comparison. So I've summarized that in a table here, so I'm not going to go through it, but that's basically a summary of what I've discussed. So Insurer A is a useful one to look at because with OCI you can see exactly this potential impact of measurement at different rates. And I think it's important to understand that because, again, with the communication of results, I think it's quite important. So if we look at this first stress, its lapses go up by 10%. We can see that lapses increasing is costly. So we've got a big impact through CSM of 6.2 billion. And then we have an increase on losses on onerous business of 1.6 billion. But this item is interesting. So this is the item of what is the impact of those basis changes measured at initial recognition rates, which is what's being taken through the CSM, and what is the impact measured on current rates, which is being taken to the balance sheet. And that discrepancy is 2 billion rand, positive. So what you end up with in this situation is you end up with a stress which is very much detrimental to you, but actually creates a positive equity impact. And that's that becomes quite tricky, I think, to communicate with analysts and to understand. And that's why, for insurers who don't show the split, I think it might be useful to actually show the split to get a proper understanding of what's the genuine impact on onerous business versus what is this noise of different interest rates impacting the size of the stresses. We can see here with this example that the impact on fulfillment cash flows is not symmetric. So again, if you only show stresses in one direction, are we comfortable that it actually is a symmetrical impact? And then, we see a similar thing if we look at the mortality and the morbidity impacts. So notwithstanding, I've just said how difficult it is to compare everyone, but I've then put everyone on the same set of axes. But I think there's still some value in having a look at this. So this is looking at a mortality and a morbidity sensitivity. So in instances where they aren't combined, we've just added them together. But you can see some of these trends playing out when you look at it per insurer. So for insurer A, you can see a very big difference between the profit and loss impact on an up and a down stress. You can see, which speaks to the potential position of some of those underlying IFRS 17 groups, which we don't have any information on, but it potentially speaks to the fact that you're more sensitive to a downward stress than to an upward stress from a profit and loss point of view than you are to a downward stress, which, like I say, speaks to the level, the CSM of those underlying groups. For the upward stresses, for the insurers who produce that, we see quite a consistent kind of level of onerous versus profitable, onerous versus CSM impact. And then for insurer E, we don't see that big discrepancy between the up and the down stress, which speaks to the fact that those groups that are in an onerous position are very much in an onerous position, and those groups that are in a profitable position are very much in a profitable position. So there's not that asymmetry between up and down stresses. Annuitant mortality sensitivities are interesting. So I think, earlier it looked as though a lot of the profitable business was annuity business, just given those lower acquisition costs, if you remember, of insurer B and C. And you can kind of see that play through here, because where we stress annuitant mortality, we see much less variability in profit and loss, and a lot more through CSM, than we do when we look at assurance mortality sensitivities. And so what this is kind of showing is that the annuity business as a whole in South Africa is obviously a lot more geared towards the profitable side. And then on lapse sensitivities, interestingly, the lapse sensitivities, we don't see as big impact through profit and loss as we saw on the mortality sensitivities, but the same trends that we saw earlier play through here. So we see the greater differential in the profit and loss impact on insurer A, we see the less differential playing through on insurer E, and a relatively similar level on the upward stresses across all insurers in the market. So again, in this section, what's the recommendation? Well, we could potentially push for consistency in the quantification, so some of those nuanced differences, the presentation of the sensitivity disclosures. We could decide on a set of standardized sensitivities so that everyone is at least running the same thing. And then, importantly, I think a breakdown, if you want users of your financial statements to understand what's driving some of these equity impacts, potentially a breakdown of what's genuine change in onerous, what's IFRS impact on profit and loss, if you don't have that information already disclosed. So if I can conclude, I think we've looked at the three different disclosure notes, and I hope you can appreciate that, on the face of it, everything looks very comparable. The structure of the notes is very similar between insurers, so you'd be inclined to go and just compare them directly. But there is obviously a risk in that without knowing the nuance, without having the context of some of these technical items. And so what can we do? So just bringing it all together, so we could potentially look at being a little bit more forthcoming with some qualitative information, be that around the split of what's in your GMM business, a little bit more detailed information in terms of how we allocate down to a policy level when we're doing that group allocation process, a little bit of qualitative information in terms of how have period-on-period changes actually impacted our CSM generated on new business, and what's the reason for changes in CSM on new business. And then on the CSM, potentially we could look for areas of consistency. So on the CSM side, maybe we should standardize how we show CSM runoff, whether that be with accretion or without. On the sensitivity side, standardizing for certain sensitivities as well. But I think overall then, just as time zones are not perfect, and they probably never will be, it might be a bit of a pipe dream to assume that we would get perfect consistency between all insurers under IFRS 17. But I do think there are elements, and hopefully there's a bit of a discussion around it, there are elements that we can enhance as actuaries and drive that enhancement to at least improve the elements of comparability between insurers. Thank you.
Thank you so much, Brendan. We're opening up the floor now for some questions. Please just walk to the aisle, raise your hand, and then you can fire away.
Thank you.
Brendan, thanks very much for the talk. And just thanks for your contribution to the IFRS 17 journey as a whole. Just listening to this, the ISB intend to have some sort of thematic review, I believe. First of all, you'd have my vote to go and to go there on AS's behalf, but it's a long list, right? And I'm sure that there's lots of countries around the world who each have their own considerations. So I know it's probably a little bit difficult, but if you were to just pick two that we would go there and present to the ISB to say that we think that this is what they should consider. I'm obviously also cognizant that, they may or may not listen, or that might not necessarily get prioritized. So off the back of that, to the extent that, those don't end up kind of bearing fruit, to what extent do you think that we as a kind of group of people through the society should be looking to ensure this, or, some sort of guidance notes or additional disclosure requirements, albeit onerous, it could be really useful, or do you actually just leave that for the kind of behind closed doors discussions with analysts? Thanks.
Yeah, thanks, Ronaldo. I mean, it's an interesting one because I think there is currently, and I think there will continue to be pressure from analysts, and so that will be one driver of it, I think, in terms of, I've spoken a lot to analysts, and I've heard their views, and that's obviously contributed to a little bit of what we've discussed today. So I think there will be some pressure there. I think there will obviously be a massive aversion to fundamentally changing financial statements, and I appreciate that because there's been a huge effort in terms of building them. But to the extent that we can do something with some slight enhancements. I think what I'm talking about here is not necessarily major enhancements, but some slight enhancements. And it's not too onerous on the company to bring through, and that information all exists. All of this information exists at a specific level. Personally, I think it is worthwhile having a discussion. And there might be a lot of people who are very averse to it, and then the discussion goes nowhere. Or it might be a case of, well, actually, I'm not that dead set on not showing interest accretion, or I'm not that dead set on showing interest accretion in the CSM release, because it's the same information, basically, that's being just presented in potentially somewhat confusing way to users of financial statements. I suppose it would be interesting to see, what jurisdictionally, what else is happening elsewhere in the world in terms of what they've seen. I would imagine I don't think South Africa is that much different to the rest of the world in terms of you've had different teams approaching things in different ways, interpreting things in different ways. You've had all the same advisory firms involved, and we've ended up in this position here. So I think it wouldn't be uncommon for it to have ended in a different position elsewhere. But yeah, I think there will be a bit of sort of self-regulation and making things easier for analysts. And I do think there will be a push more and more towards some qualitative information. I think it's very, very daunting to open up a set of financials if you haven't been involved in the IFRS 17 process at all. You've got all the new jargon and everything to come to terms with, and then you're presented with a table of 100 numbers, and there's no insight or there's no explanation of what's going on in those numbers. So I personally, I think it will probably come, and then I suppose it's just, is that going to be driven by ourselves having a discussion, or is that going to be driven by some sort of guidance note, or I don't know. But I think it's worth a discussion. That's kind of my view.
Any other questions? Okay, I'm not seeing any. I'll ask one from my side while you all still think about it. Brendan, I just want to ask from your own opinion, almost 3 years into IFRS 17 standard, was it really worth it at the end of the day? Or, were they just creating more jobs for us actuaries and accountants? What's your take there?
Yeah, well, like I said at the start, I don't want people to think I have Stockholm syndrome. But no, I think on the whole, I think unequivocally IFRS 17 has benefited comparability. I think if we look at if we take an honest assessment of where we came from IFRS 4, things were completely incomparable between insurers. And there wasn't any, numbers used to be kind of hidden to a large extent. So the actuaries would produce a change in reserve. That's the number that would be shown. No one had much insight into it. So what IFRS 17 has done, I understand everyone's reticence with accepting this, but that information is all there. So it's going to take some time, I think, for everyone to properly understand exactly what information is there. Is it useful? I think there is going to be that natural sort of settling phase. But after a few years where people have had a chance to really grapple with it and really come to terms with it, the understanding that your view of the business is so much more open as a user of a financial statement, whereas before you were very, very reliant on a single number and a little bit of qualitative disclosure. And it was impossible to unpack that number and understand what was going on about it. So even just the sensitivities, seeing these profit and loss impacts, if you look at an asymmetrical profit and loss impact, an insurer doesn't need to disclose what's happening at an IFRS 17 reporting group level for you to understand how a sensitivity is going to impact that IFRS 17 reporting group level. So I think on the whole it will be seen as beneficial, but I think it's going to take some time for everyone to come to terms with that. That's my view.
Any more questions from the floor? I've got one as well, as a non-actuary. How important is stakeholder engagement and making sure that all stakeholders are involved, be it professional bodies, regulators, insurers, other actuaries, to also give their input in any new regulation that's being introduced or implemented?
Yeah, I mean, it's not as though there hasn't been some engagement on this. The JSE has been engaging from their perspective to question certain things that have been disclosed or haven't been disclosed. But I think it is very important. You've got certain people in companies who are talking to analysts. You've got the actuaries producing the results. You've got the accountants who are sort of consolidating these numbers and the ones responsible for producing them and disclosing them. You've got the executive teams who have to present these results to analysts. You've got questions coming back. I mean, these numbers touch so many different areas in the business, and they have very big implications. I mean, they have ultimately an implication on the share price, which is why they're so important. And so I think it's important then, and that's why I wanted to kind of bring this discussion to the fore, because if we're in a position where, for the investment of one or two additional tables or one or two qualitative notes, we can enhance things, and it's ultimately in the company's best interests. So I think it is important.
Sure.
Brendan, thanks for the work. I want to ask, what's your view on embedded values in this world? And should we be reconning IFRS 17 with EVs? Thanks.
Yeah, thanks, Marguerite. I might get shot. I don't know. It seems to be a very divisive topic, doesn't it? I mean, my view on this has always been, we've got so many different bases floating around now. You've got SAM, you've got EV, you've got IFRS 17. I mean, for you to justifiably have a separate EV basis to an IFRS 17 basis, I think, is quite difficult. The question is why would there be a difference? I think we have to acknowledge IFRS 17 is not an EV. It's not suitable for EV, but it could be made suitable for EV with a couple of additional steps. So if you use IFRS 17 as a base, or you use SAM as a base, and you have steps to address the shortcomings in terms of putting an actual value on the business, I think both of those, as a starting point, have so many of the building blocks that are necessary. I think my question then is, well, what value does a completely separate basis have? What necessity is there for that, when you can, with a few small tweaks, make a number that is meaningful, and then at least you don't run the risk of having to try and tie all of these bases back together. So, I mean, my view is start with IFRS 17 and address short contract boundary business and all non-attributable expenses and all of those known areas of discrepancy, and then at least you've got a consistent basis. Everything's modeled on the same set of assumptions, same discount rates, and I think you've then got a pretty good metric for the value of your business.
Quite interesting, because this EV IFRS 17 question was in the fellowship exam of this very session, so I hope all the students were paying attention.
Is there any other questions from the floor? Well, Brendan, thank you so very much. We will then... Our next session is on employment equity, and we will have Wilhelm de Wet for that, so come back for that in about 15 minutes.